Welcome to today's market report.
A closely watched US inflation report next week could help settle one of Wall Street's most pressing questions, whether the market has correctly pegged the near-term trajectory for interest rates. Following last month's banking crisis, investors have become more convinced the Federal Reserve will cut rates in the second half to ward off an economic downturn. Such bets have pushed bond yields lower, supporting the giant tech and growth stocks that hold sway over broad equity indexes. The S&P 500 has gained 6.9 so far in 2023, but the central bank's more restrictive rate outlook sees borrowing costs remaining around current levels through 2023. The view could gain support if next week's inflation reading shows a strong rise in consumer prices, even after aggressive Fed rate hikes over the past year. If CPI comes in hot, investors will start to price interest rates closer to whether the Fed is and likely pressure asset prices. The US employment data for March, released Friday, showed signs of President labor market tightness that could prompt the Fed to hike rates again next month. Recession worries are mounting, with investors betting the tumult in banking system sparked by the March collapse of Silicon Valley Bank will tighten credit conditions and hurt growth. The Fed's preferred recession indicator plunged to fresh low in the past week, bolstering the case for those who believe the central bank will soon need to cut rates. The measure compares the current implied forward rate on Treasury bills 18 months from now with the current yields on 3 months Treasury bill. Pricing in future markets shows investors betting that central bank easing later this year will drop the Fed funds rate from 4.75% to 5%, currently to around 4.3% by year end. Yet projection from Fed policymakers showed that most expect no rate cuts until 2024. It is UK bank holiday today. GBP/USD is at 124. Euro/dollar is at 108. This is today's market report. Thanks for listening. We'll see you next time.